What's up, strategic investors? We're here to bring you breaking news regarding cryptocurrency and macroeconomics in a simple way that's easy to understand. This is one of the most volatile periods of history in the last several hundred years. Economics and cryptocurrency has never in history been as important to understand as it is today. We're looking to build a community of some of the brightest minds in all of finance. Asset management is like a game of chess, and we're always looking to stay one move ahead of the competition. Subscribe to our channel to become a part of the most comprehensive upcoming communities in cryptocurrency and economics. So enough with that, let's get to the content you all came here to see. What's up, everyone? The Strategic Investor Productions channel is now back in action. So, because it's been a couple months, I thought it'd be a good idea to, take a step back and take a look at everything that's happened in the last couple months and just see where we're at. So, we've been in consolidation for a couple months now, but it seems like everything's coming to a head where markets are going to decide which way they want to go in the short term. So, I have a few things that we can look at just to see what way we think the markets are going to go and what we think is going to happen over the next couple months. So equity markets have come down quite a bit this year, and it's been the worst start of the year in all of recorded history. And we're at a point where valuations are making more sense than they did at the beginning of the year. So a lot of people are starting to flip and get a little bit more bullish on the markets than, say, they were a couple months ago. But the price of equities is only one side of the equation when it comes to valuations. The other side, there is a variable that we could input called earnings. So if you've ever heard of a P to E ratio, it's called price to earnings. It's a way of valuing a company based on what it's bringing in and earning, rather than, say, a sales or revenue forecast. So prices of equities have come down substantially, and they're more in line with earnings at this point. But with that being said, earnings season for quarter two is about to kick off. If anyone knows about Stanley Druckenmiller, they know, or you probably know about his story in the tech bubble back in 2000, where he didn't do too well the first couple years, took a break, came back, and absolutely crushed the market going forward. One of the things he quotes, saying that when he came back from taking his break that he noticed that gave him more confidence to make decisions, was that he noticed that the dollar was up, yields were up, energy was up, and that most likely meant earnings were coming down. So if anyone's been watching the markets as of recent, you can tell that the dollar is up, yields are up, and energy is up. Maybe not over the last week or so, but in aggregate over the last couple months, this is true. Therefore, it's reasonable to believe that earnings could be coming down over the next couple quarters. Will we see the decline in quarter two earnings? That's questionable. And we just got a retail sales report the other day that was a beat. So, it might not be reflected this early on in earnings reports, but even if earnings come out stronger than expected this quarter, there will probably be forward guidance that spooks people going forward. So I have an infograph up here from earningswhisper.com, and it shows the bulk of the major companies that are going to be announcing earnings over the next month from July 11th to August 11th. And keep in mind, these are just the major notable companies, and there are other companies that announce outside these dates. So this isn't the full spectrum of information that we need to be looking at, but it's a good place to start. And if you notice from this infograph, most of the earnings really begin to pick up starting next week, Monday the 18th. We do get a couple pretty big names that announce next week, but the biggest week to be watching is the week of the 25th to the 29th. On the 26th, you have Microsoft and Google. On the 27th, you have Facebook. And the 28th, you have Apple and Amazon. So as we go through some more of this economic data that we're going to be looking at, you'll notice not only is this a big week for earnings with some pretty major names, there's also a lot of other very important data that are going to be coming out this week. And not only just that week, but the 28th also. So it's going to be paired with Apple and Amazon earnings. So it's going to be a big week and an even bigger day on the 28th of July. We've already seen a couple companies come out, and while they haven't missed substantially, their forward guidance going forward has been pretty abysmal. GDP was down last quarter, and this quarter, the Atlanta Fed is predicting that it's going to be even lower. Well, I'm not as confident that quarter two earnings season is going to be in aggregate a miss. I do think that a lot of the signals out there are suggesting that it is a very high possibility, or maybe even a probability. This is definitely something I have an eye on and will be paying close attention to over the next month. All right, let's move over to the economic calendar and look at some of the data that's going to be announced next week. So you can see that early on in the week, we're going to get some housing data that comes out, and that will be interesting to look at. Really Tuesday and Wednesday, but more importantly for what I'm doing in the markets and what I'm paying attention to is going to be Thursday and Friday. We get initial jobless claims and some manufacturing data towards the end of the week. And I think the employment data is very important because that's why the Fed is so confident in their tightening, is because, quote unquote, the economy is strong and the labor market's not showing any cracks at the moment. So if we get a little bit more momentum to the downside with jobless claims and employment data, that could really put some pressure on the Federal Reserve to actually consider what they're doing and put more thought into their actions. What a concept, right? And then manufacturing data is a little bit of a better indicator than, say, like a retail sales, or it gives you a little bit more of an advance notice to what's going on in the markets, a little bit more than some other consumer data. So the big one down here is going to be the PMI is pretty close to 50, and it's projected to come in at 53, above 50, but it missed pretty badly last time, and I think there's a pretty good possibility that it's going to do the same this time around. So I'd be watching for this to maybe even print under 50. If these numbers drop below 50, that would definitely reinforce these recession fears that everyone's been talking about. And then also on Thursday, we have some other data coming out. It's going to be the direct investment by country and industry for 2021. So this is old data regarding last year, but I still think it's going to be pretty relevant to see, just to confirm what some of these other countries are doing and some of their game plans as to what they're going to be doing going forward also. 2021 is a little bit of an interesting year regarding this, because at the beginning of the year, you might expect that there would be a net outflow from the United States, but towards the end of the year, that's when things get a little bit interesting. So it would be interesting just to see where the net result landed for the aggregate 2021 data. And that rounds out the rest of next week. So not a whole bunch of data coming out next week, but certainly more than the last couple weeks or even last month or so. So there's going to be a lot more data coming up, and let's come over here and take a look at the Federal Reserve website. So on July 26th through the 27th, they have their FOMC meeting, and I believe the actual meeting is on the 27th. So let's come back over here, and that's going to be right in the middle of these 5 major, pretty much FANG stock companies coming out and releasing earnings. So you have the Fed meeting on the 27th. So that's going to be pretty interesting to see, especially if Microsoft or Alphabet miss, or maybe even some other big names. There's going to be a lot to talk about at this next meeting. And then if we come back over here, you can notice July, August. There's no August. September, October, there's no October either. So after this meeting, there's only going to be one more meeting over the next 3 months. So this meeting is going to be very influential. There's not going to be a scheduled chance to update policy throughout the next several months after this. That means the Fed has one last chance to get their message across before there's a break in communication going forward for at least the short term. Of course, they can always do emergency policy measures and announcements and all that good stuff that they have done throughout the years and over history anyway. But I would just see this as a chance for the Fed to really make a statement coming up. So consensus right now is that the Fed is probably going to raise by 75 basis points at the next meeting. But we had a very strong CPI report, and then we also had some consumer data come out, such as the retail sales, that also beat. This is suggesting that their actions thus far have not made the impact that they were hoping they would. The Central Bank of Canada recently came out and did a 100 basis point move. There were some rumblings that the Fed might follow suit, but Nick Timiraos went on Twitter and he was actually discrediting this, and a lot of people kind of see him as the canary for the Federal Reserve to leak data out. So a lot of people take him pretty serious, but if you look at the circumstances and just kind of run through game theory and put yourself in the Fed's position, this is their last chance to make a statement for a couple months, so I think they're going to use that to their advantage and really surprise some people. Although that thesis could be a very slippery slope as we get another piece of economic data released the day after the FOMC meeting, and that would be the advanced estimate of quarter 2 GDP for 2022. That is on July 28th. And if we go back to earnings, that is also the same day that Apple and Amazon announced. And right after we got Facebook, Microsoft, and Google. So if we think about what happened last quarter with GDP, the Fed said that it was going to be slowing, or at least the Atlanta Fed GDP now predicted that GDP would slow, it would remain positive, but it wouldn't come in negative. So we got the actual print of the GDP, and it was, I believe, give or take a little bit, like negative 1.5. So they were off by quite a bit. So now they're coming out and saying that they believe the GDP for quarter 2 of 2022 is going to be about negative 1.5%, similar to what it was in quarter 1. But as we've seen throughout history, the Atlanta Fed's GDP now is not very accurate, or as accurate as they would like. So if they're predicting a negative 1.5% GDP, that means that it very well could be quite a bit lower. And previous estimates several weeks ago even had it down to below negative 2%. So it's going to be an interesting one to keep an eye on for sure. I guess let's just hope they're not as optimistic this quarter as they were last quarter, because that would be abysmal. All right, so we can see that the rest of the month is going to have a lot of data coming out. There's going to be a lot of opportunities for volatility to pick up and a lot of opportunities for things to go ways that people weren't necessarily expecting. So I would expect that markets don't find themselves in consolidation anymore by the end of the month. I would say within the next couple weeks, these markets are going to end up picking a short-term direction going forward. So with that being said, let's hop over and take a look at some charts that might help us decide where things are going to be going in the near future. So this is a chart of the VIX, the volatility index for the S&P 500. And as you can see, we've been in a consolidation range for several months. And this consolidation range really has been all the way back to the beginning of the year, although that's when the range was being formed and volatility was the highest. So you can see that the consolidation has really tightened up over the last couple months. We are currently down here around the support level, and we're actually on the simple moving average down here. So unless this really is a break of the consolidation that we've seen in volatility, and we do get a period of time where things kind of even out and there's less volatility, you might see that the volatility pulls back down to this green line, which is the longer term structure that it's been in since about the pandemic, that time frame. But if we don't have a shift in structural trends, this right here is on support, and we can expect things to become more volatile. And with all the economic data coming out over the next couple weeks, I would expect that to be the case. So let's move over here and take a look at the DXY. The DXY charts the strength of the dollar as a foreign exchange asset against other currencies from around the world. Not all of them, but a lot of the major currencies. Mostly the euro. But you can see that the strength of the dollar has actually been very strong still. And we're right up here. We topped out around 108. So this was as expected. You had kind of a not very good head and shoulder, inverse head and shoulders. It was also kind of looking like a diamond pattern, but didn't really fit either one of them technically quite as well, but it definitely acted as if it was a pattern of such. And that broke higher. We're now up here on resistance, and this resistance has just been kind of the mean of this move up. You can see some of the time we spend above it when the dollar is really strong. Most of the time we spend below it. A lot of the time we actually spend on it. So this right here suggests that we're right up here around the mean at the moment. We just touched up there and we're pulling back, although the dollar is still very strong and is structurally in an uptrend still. So why is a strong dollar important? It basically means that everyone wants to get their hands on dollars, and there's not enough dollars to give everyone the amount of dollars that they want. So people have to pay more for each incremental dollar as the supply runs smaller and smaller. So as the DXY goes up, it shows that there's more demand for dollars than the currencies that it's being compared to, which is mainly the euro. And recently we've actually seen the euro come down to parity, and it is trading within a cent of the US dollar. And this is the first time we've seen this in about 20 years, ever since the euro came into existence. Another thing to keep in mind with the dollar that isn't shown on this chart is that the Chinese elections are coming up. People are not so happy with Xi Jinping, and he's probably going to have to try to win some votes. I don't know if the votes even matter out there anymore, but just for the sake of publicity and keeping his name as royalty, or seen as royalty out there, or whatever it may be. With the lockdowns that China had, there's been food shortages, there's been water shortages. It's been kind of a mess out in China. So I'd expect them to come in and try to soften up the landing a little bit in Chinese equities and just kind of come in and cushion up the markets a little bit going forward, at least until the elections. And I believe they're going to be doing it more so than the United States, which suggests that the Chinese yuan could actually devalue against the dollar considerably over the next couple months. And that doesn't get shown on this chart, but it's something to keep an eye on. So let's come over here and take a look at the 2-year treasury yields. All right, so you can see the treasury yields have been in quite the uptrend over the last year. And this blue line up here is the resistance dating all the way back to the 1980s. And this is usually where yields come up to before the Fed has to come in and start doing quantitative easing. I guess they're eating all the bonds and the treasuries, so I guess that works too. But it's up around this blue line where we usually get a sustained yield curve inversion, and that's actually what we're seeing right now. So you can see the 2-year yield came above this blue line pretty substantially, has came back down, retested along with this SMA line down here, which has been support throughout the whole uptrend. You can see, didn't touch it, but it came down to try to test it. Over here, we came back down, tested it, and now we're coming back down, testing it again. We've resumed upwards, and now we're testing this higher SMA line as support. And with inflation doing what it's doing still, I would not be surprised to see this move up to a new higher high before the end of the year. So while yields have got a little bit of a pullback, I don't believe they are going to substantially change the trend to more of a bearish trend going forward in the near term. I think that there is a point where that happens, probably in the near future, but probably not right now, in my opinion. Another story that we can look at regarding something very similar would be the yields of 10-year Treasury bonds. So the 10-year has also been in a pretty nice uptrend over the last year, and a very similar story. This blue line dates all the way back to the 80s as resistance. You can see we broke above it. We came up here, retested, found a new higher high, and now we're down here. But if you notice, we are underneath this orange SMA line, which has acted as support. You know, you did break through it down here, and we held support at this middle line down here, but it did act as support here, and you can see we have come down and we're making a move similar to something like this right now, but we're getting hung up on this other support line up here. So this chart does not look as strong as the 2-year yields. So I would think that this chart is suggesting that 2-year yields might or probably will move higher, whereas the 10-year yields probably won't move quite as high if they do move higher, or they might just consolidate or might even pull back a little bit. And this makes sense as long-term Treasury bonds are definitely a place to hide out in a recession traditionally. So this is usually why you get an inversion of the yield curve, as people are a lot more confident in the government being able to repay its loans further out on the timeline than they are sooner in with the 2-year. So people think the economy is going to be looking better 10 years out than it will be 2 years out. So that's just a way of looking at what a yield curve inversion of the 2s and 10s actually means. So if we start getting some demand for these 10-year Treasury bonds, I think the yield curve inversion's actually the spread's gonna blow out quite a bit more. And we can take a look at that right now. So this zero line here is exactly what it suggests. It's a 0% spread between the 10-year and the 2-year. So this chart, you're taking 10-year yields and subtracting 2-year yields. So when this is negative, it suggests, or it is showing that 2-year yields are higher than 10-year yields. So right now, we definitely are in an inversion period. And not only are we inverted, it's sustained and it's getting worse. And this is what we've been looking for. So we did get an inversion back here, which was notable, but it wasn't sustained. It only lasted a day or two. This one is going on over a week and probably pretty close to 2 weeks worth of economic data to be looking at right here. And it looks to be getting worse. A yield curve inversion has nearly almost always predicted a recession. I think there was one time, maybe back in 1994, where it inverted and we didn't actually get the recession, but I don't think it was a sustained inversion, but don't quote me on that. I just know that a lot more of the time than not, when you get a yield curve inversion, it's followed by a recession within about 12 months. And another thing to note regarding yield curve inversions is back in 2019, there was an FOMC meeting where Jerome Powell actually quoted on this. He was saying that after about 30 days of a yield curve inversion, they tend to come in and start doing quantitative easing, as obviously things aren't functioning correctly, as 2-year yields are higher than 10-year yields, which makes no sense. I mean, it does make sense, but structurally, mechanically, that's not the way it's supposed to happen. So He was quoted back in 2019 saying after 30 days of a yield curve inversion, they take that pretty serious, and it has in history been something that they've taken action on. Well, I don't think 30 days of a yield curve inversion is more important than a 9% inflation print in the eyes of both the Federal Reserve and the United States government. I do think it is something that we should be for sure paying attention to, and it is something that they will notice and probably are paying attention to already. And interestingly enough, 30 days of yield curve inversion would put us at about their next meeting. So if we stay inverted for the next couple weeks, I will be interested to see if they get asked about it and what they say when asked about it. And based off the 10-year and the 2-year charts that we looked at, looks like the 2-year wants to go higher. It looks like the 10-year wants to either go lower or consolidate, which suggests that not only will the spread sustain over the next couple weeks, but will likely blow out even farther and widen even greater. All right, so let's go over here and take a look at junk bonds. All right, so you can see the junk bonds. You had two pretty strong support lines up here, and as soon as they broke underneath both of those, it's been a free fall to the downside. You do get a couple points in time where you do get a nice little dead cat bounce coming up there, another one here. Both times you meet some moving average resistance and continue pulling back down to new lower lows. What's interesting about this chart is this actually does look like a pretty nice bottoming pattern right here. You have a bottom, you come up here, you retest, you come back down, and it's pretty close to a double bottom, but you do make a higher low, and now you're back up here retesting kind of the breakout point right here. So I don't think the thesis suggests that we should be breaking higher, although the technicals on this chart suggest that we very well could see a break higher of this blue line over the next couple weeks. And I would believe that we retest this dotted line that my cursor is showing right now, as that was the low of the last move, and it is also the SMA line that we like to pull back on our dead cat bounce. So maybe we get a little bit of a fake out over the next week or two in junk bonds, but I'd expect to see a month or two down the road that junk bonds are at a lower price than they are trading at today. All right, so another form of bonds that produce a higher yield and are more risky are emerging market bonds. And the interesting thing about these bonds are not only are they emerging market bonds, but they're denominated in US dollars. So these bonds, it's not a Chinese bond that needs to be repaid in yuan. If China owns one of these bonds or issues one of these bonds, it's denominated in US dollars. So it needs US dollars to be repaid. So if we look at this chart, it's pretty similar to the last chart. You had a break below some pretty significant support levels up here, and it's been a free fall ever since. We also had a couple dead cat bounces around the same time and pulled back to a very similar resistance level as the junk bonds. But the interesting thing to note regarding these two charts is that junk bonds actually formed a higher low on this pullback, whereas emerging markets lost their bottom and went down to new support. So there actually has been a divergence between junk bond and emerging market bonds denominated in US dollars. So what can we take away from this? And I don't think this divergence is actually going to be sustained over the next several months. I think it's something a little bit more short-term and speculative regarding traders. So with the United States dollar stronger and yields pulling back, that would suggest that US companies are going to outperform the emerging market companies. So I don't think this is suggesting that junk bonds are a good entry point right now or anything of the sort. I just think it's more so that emerging markets are dealing with a higher strength in the dollar. It's harder for them to deal with it than it is for US companies to deal with it. So I just think that's probably what you can take away from the divergence in the charts at the moment. But I would think that junk bonds are probably going to be coming down to resume their bearish trend, just like the emerging market bonds here in the near future. All right, and if we take a step away from currencies and bond markets, we can come over here and take a look at some commodities, as they've been doing really well over the last year, and they're in the new super cycle and they're all going to 1,000,000, and we're going to take a look and see what's actually happening with them. So you can see that we have been in a very strong uptrend over the last couple months to a year, and we did break above some pretty key target levels up here that I had, and came up here, and now we're pulling back at a very fast delta. So this is coming down fast. We did come back down here. We are holding support at this bottom SMA line, which has been support in the past. As we can see back here at the end of last year, it also held as a support before we ripped to make very high new highs. So this very well could be a nice support level to be buying at. Or if we are in a more of a structural recession, this could be a bear or a bull trap, and we could see this move quite a bit lower. So I'm a little bit more reluctant to kind of try to figure out what exactly is going on here or speculate on what might happen going forward, because I honestly don't know, and I think there's some pretty good arguments from both sides. You know, the price is coming down, and I think there's a lot of macro factors that suggest that it probably should be. But if you look at the actual supply and demand metrics for commodities, and more so a lot of these energy commodities like oil and such, the supply problems have not been fixed. So, you know, even with all the, even if you want to say this is demand destruction, the supply side is still a problem, and that's what's been the problem. And definitely the major factor in what's been driving prices higher in commodities rather than the demand side. But the demand side did play a factor, so it's kind of just hard to tell at this point, at least when it comes to industrial commodities. Even if we do get a breakdown in commodities in aggregate, I would expect energy to hold up more relevant or relative to the rest of commodities. Agriculture might hold up a little bit better also, but I don't know. I think if you're wanting to short the market, maybe go with base metals or something of the sort, at least for the time being. I definitely wouldn't feel too comfortable shorting energy, so just be careful. This could go either way, and whatever way it goes, it can go fast and it can make a big move. So definitely feels like a gamble at this point, at least to me. But if we take a look away from industrial commodities and come over here and take a look at some precious metals, and more specifically gold prices, I think this will paint a better, or maybe not better, but a more clear picture to illustrate what's really going on at the moment. So with gold, you can see we have had a pretty substantial pullback for gold, and this was extremely surprising to me, as everything that's been going on in the world. We had the sanctions in Russia basically showed the rest of the world that treasuries are not a good reserve asset to be holding and storing your trade surplus in, as at any given time, if the United States gets emotional and wants to seize all your assets, they can do it. So I think we sent a message to the rest of the world saying that treasuries are no longer going to be the primary reserve asset for the world. And I thought this would be a huge bid for gold going forward, and I still think it will, but I think that this chart is showing us something very different. And while gold has a very bullish case for the next 5 to 10 years, I think it's showing us right now that things aren't as rosy as some of the more optimistic economists out there are talking about at the moment. So gold, when you get into a stagflationary environment, tends to perform pretty well. The way I see it is Bitcoin and gold both do well with high inflation. Bitcoin does better when you get inflation and growth. Gold does better when you get inflation and declining growth. So theoretically, with inflation high and GDP coming lower, I'd be expecting gold to be performing pretty well. But this chart right here is suggesting that we are not in a stagflationary environment anymore. And that would mean one of two things: that growth is going higher along with inflation, or inflation's coming down with growth. And if anyone's been watching the price of Bitcoin, I don't think that we're seeing a situation that suggests that both growth and inflation are going to be consistently going up over the short term over the next couple months. So I think that the chart of gold right now is really showing us that not only is there demand destruction, but I think the demand destruction is actually working, and I think we might get some inflation surprises to the downside over the next couple months, or maybe even sooner, the next month. I don't know. That sounds optimistic. I don't want to call the exact top, but I think the chart of gold is suggesting that that's in the cards for the near future. So declining growth, declining inflation suggests a pretty bad recession is on the horizon, and we're approaching it pretty quickly. All right, so let's hop over to the equities market and see what's going on over here. So you can see that we are in a very nice consolidation pattern over the last couple months, and we are hanging up there around resistance right now. We are definitely coming towards the end of the consolidation pattern, and we could, consolidate some more, but we're going to be breaking the pattern next week regardless. We're either going to break out to the upside, to the downside, or right through the middle of the tip of the triangle. So by the end of next week or the week after, we're not going to be in this wedge pattern anymore. So I would expect either a move to the upside or the downside, especially with all the data that we've been looking at and all the other asset classes also hanging at either support or resistance levels. I would say that everything is suggesting that we start picking up momentum again, and it's either going to be up or down, and my base case is probably that it's going to be to the downside. So if we hop over to the Dow Jones Index, you can see that we are making a very similar pattern to the S&P 500. We are in a nice wedge pattern and hanging out around the resistance level in the wedge pattern within that also. So we're at a couple pretty nice resistance levels, and probably within the next week or two, we're going to be exiting this consolidation range, and I believe that suggests price discovery, and my base case is to the downside. So if we hop over to the triple Qs, the NASDAQ, it's going to show a pretty similar chart, although there are a couple differences. It's kind of like the divergence between junk bonds and emerging market bonds. You can see that we are in a wedge also, a nice little consolidation range over the last couple months. But the difference between this chart and the Dow Jones and the S&P is we are above previous support. So the other charts, this line right here is still acting as resistance. Whereas on the triple Qs, this line has actually now working as a support line. And I think the relative strength in the triple Qs relative to the S&P and the Dow Jones probably relates back to the same situation as junk bonds and emerging market bonds. You have yields are cooling off and maybe even pulling back, and you have a strong dollar, which strong dollar environments, US companies tend to outperform emerging markets, and when yields come down, they support tech companies a little bit better. So I think both of those combine to paint the picture for what's going on in the Qs, but I believe that if the rest of the markets move down, that's going to happen with the triple Qs also. So I wouldn't expect them to perform any differently if we do get another turn to the downside here in the near future. Or if they, if everything ends up moving higher over the next couple weeks and my base case is wrong, I definitely could see the triple Qs outperforming the Dow Jones and the S&P as long as the dollar, I think they would outperform even if the dollar doesn't remain strong, but I think that would help with the US companies that are within the triple Qs, and it would certainly be the case if yields really pulled back considerably. So that is a possibility, although I don't believe it's the probability, so that's not my base case. But if we do get a breakout to the upside, I think you could get some better returns playing triple Qs in the S&P and the Dow Jones. So really, there's so much data coming out over the next couple weeks to a month that really there's too much of it coming out to really be super confident about what's going to happen by the end of the month. But I think the one thing you can be pretty confident about is volatility is going to pick up, or maybe not volatility, but we're going to be breaking out of our consolidation in all these markets. So maybe it's not the VIX that actually picks up, but there's going to be a lot more going on, and these trade ranges are going to be broke, whether that be to the upside, to the downside, and maybe even right through the middle. But I don't think that's far from my base case. So I think markets are going to pick a direction by the end of the month. It's going to be either up or down. My base case is down, and I think there's going to be a lot of data coming out over the next couple weeks to stay busy with. So have a wonderful weekend, everyone.